I've got a fun one for you today. I figured that we should take a look at the prices of things on January 1st of this year and then compare it to today, which is June 18th, 2024. And we'll watch and see what happened to a lot of the things, the prices of a lot of things. We're looking at gold, lumber, silver, oil, house prices, even some fun things like copper and cheese. We're going to get into all of it, and we'll talk about how their prices changed over time and some of the major things that have happened during that time. And there's a lot of major things going on right now that are going to affect a lot of these things we're talking about today. And it seems like no one's paying attention to how big this is going to be. But in the next 3 or 4 weeks or so, I believe that the world is going to start realizing and recognizing that this invasion into Lebanon by Israeli defense forces is almost certain to happen. And that would be a major, major escalation that would have all kinds of ramifications. And the purpose of this video isn't to get into all those right now, but I'm just telling you that this is a likelihood, it's a probability, and everybody who's watching it, mainly people in Lebanon, in Iran, people in Israel, they understand that this is going to break out. It's people, the masses of the world, are not really understanding yet or recognizing yet how monumental this is going to be when this indeed does happen. I've been talking about this since October. Meanwhile, Russia's at war with NATO, basically, a proxy war. It's a Cold War right now, but you've got nuclear weapons in Poland. You've got everyone, including both sides, increasing their nuclear arsenals, as if we didn't have enough already. But the purpose of this video is not to scare you, so we're going to move on. We'll talk about the prices of things on January 1st, and then we'll talk about what happened to them over the year so far. See if you can remember or guess what the price was on January 1st. For gold, it was $2,062, while silver was $23.79. And precious metals are one of the things that gets a risk premium built into it. So if you remember, Iran was actually literally shooting at Israel, a direct attack from Iran, which is a first. That was a few months back. And since all these wars have been breaking out for a long time now, they are just going to get worse and worse. I don't see how, with the setup we have right now, with everything that's going on, how this de-escalates before something horrible happens. But there's nothing you can do about it, nothing I can do about it, but you can position yourself so that when it does indeed happen, you actually land on your feet. A big part of the trade I recently made that I sent out to subscribers of the Peter Leeds newsletter was about putting more money on the table for things like oil and gold right before a lot of things are going to start escalating, in my opinion. And so few people have their eye on this ball right now. Just the people who are directly involved, but not a lot of people that I know are actually watching this. You have to actually search it to get most of the information that you need to understand what's going on in Lebanon and with northern Israel. A couple other points. The gold to silver ratio on January 1st was 78.92. And it's wrong. I always tell you this. It should be the silver to gold ratio. It's how many ounces of silver to buy 1 ounce of gold, but everyone calls it the gold to silver ratio. Fine. So that's where it was on January 1st. And we'll tell you where it is today in just a couple of minutes. Real estate, on average, a house price was just under $500,000. It was $498,300 on average to buy a home in the United States on January 1st. Lumber was $572 per board foot. Cheese was $1.55. And copper, Dr. Copper, which is in everything, and it's a great indicator of overall economic activity, it was at $3.84. But going back to precious metals, we're going to talk a little bit about the downside of this too. I know that you've seen me talking up precious metals for years, and now there is some risk that they might have overreached, but we'll talk about that in this video. So besides the risk premium, which could spike at any moment, the only reason that an investor should expect precious metals to decline is if you believe that all this monetary creation is going to stop. The monetary creation which paid our bills to get us through the pandemic, the monetary creation which pays our bills to cover the deficit, the operating deficit of the country, the trade deficit as well. Only half of the dollars that we need to pay for what we spend money on comes from taxation now. That's really, really unhealthy. It's really low. This is a chart from the World Gold Council, and it shows you gold reserves by country. And you'll see that the gold is all moving to Asia. Gold is real money. It's actual money. It's not like currency is money. Currency is just a way of keeping track of things. Gold is actual money, always has been, always will be. But you can see the aggressive weighting of gold going towards Asia. And here's a chart from the World Gold Council, the above ground stock of gold. And something big is coming up that I've told you about, the quarter two earnings results for a lot of these major miners. This is from Bullion by Post, gold prices. Now, if you look at quarter one, that was a higher base of gold prices, so they made better earnings, revenues. But then look at quarter two, which is not reported until halfway through July. The entire quarter, they were selling precious metals for much higher prices. Therefore, their revenues will be much higher. Therefore, their earnings will be much higher. The only way that a lot of these stocks report bad numbers is if they're totally mismanaging their inventory or the resource, or they've already gone up so much that people are expecting even more. So when they report, we only made $7 per share, people are like, we thought it was going to be $9. And so they sell the stock. That's the way that the shares would go down when they report what it's going to be. Some pretty strong numbers coming up, in my opinion. But we got a wonderful question from Mark, a longtime subscriber, one of my favorites. And let me tell you what he said, and then let me tell you what I said in response to that. Mark says the question is A, do you believe I'm correct in how gold mining stocks will act in the stock market crash and recover prior to mid and large cap stocks? And to that I said, there's two parts, A and B. To part A I said, exactly, especially if the response is wild monetary creation, as it always seems to be. The dollar devaluation and purchasing power liquidation will be what eventually drives gold higher. That force will likely overwhelm the counter forces of economic decline. So, in a stock market crash, I've always said that it'll be bad for everything. Nothing is the safe harbor in that at first. When people are panicking and liquidating, look for blood in the streets, that's when it shows up. But at first, a lot of these gold miner stocks would come down at a big stock market crash, for sure. But they will, just like Mark says, he is absolutely right that they will be the first to recover out of this, especially when the response by the government will be massive monetary creation to deal with all these problems that there's no other way to deal with when people start suffering from the economic weakness. They'll lower interest rates, which is great for gold and precious metals. They'll print a whole bunch of money, which is great for gold and precious metals. And that, in my opinion, and it's an opinion, will offset the negative forces that'll happen with the stock market crash. At first, you might want to make some moves when it's first happening, but then make sure you're back invested before they have that recovery bounce. And Mark goes on to say, B, I'm concerned about silver stocks because approximately 80% is for industrial use, and in the stock market crash or recession, all those industries using the silver will temporarily drastically drop silver's price per ounce. And what I said to him was, B, also a concern. Not advice. It may be wise to watch for the first signs of collapse and then lighten your positions. So much is riding on the type and manner of downturn we experience. And then the government response. Banking crisis, currency devaluation. Let me get into it and I'll build it into an upcoming video. Here's the video right now. Again, it all matters so much what kind of downturn we're seeing. If we get a 10% decline, that's not going to be anything to worry about. If there's more like the Great Depression, then yeah, here's a chart of silver prices at the time. Silver prices went drastically low, and then they did recover, but you don't want to sit there and have dead money while you're waiting for it to recover. You might want to, some people might want to, act ahead of time when they start seeing symptoms of a declining stock market or stock market crash. But long term, don't even worry about precious metals, especially gold. Don't even worry about it. But you also want to have a lot of fresh cash on the sidelines in the event of a stock market drawdown. If you sell some of your mining stocks and the crash happens and they get less expensive and then you buy back in, that is one way I see that you could play this upcoming stock market weakness that I'm expecting. Now, oil, which was at $72.26 on January 1st, was suffering from some demand concerns. As the global economy slows down in a lot of different regions, Japan, Europe, North America, and as the recession approaches the United States, as I told you, it eventually will be here. There's big deflationary forces because of the diminished amount of activity. Just like I told you in that spike and fade video I did recently, oil's doing exactly what I told you it was going to do. It's got a bias to drift lower, and at the same time, there's so many things that can spike it dramatically in a very short window of time. So as it fades away, it'll pop like popcorn. It'll bounce if something happens. Something breaks out in southern Lebanon, or with the Houthis, or with Syria, as the war expands. There are numerous things that could cause oil prices to go up 5 or 10% in a couple of days. And when that's not happening, oil is just drifting lower with the economy. And the real estate, this is from the St. Louis Fed, the average price on January 1st was $498,300 for a house. Here is a chart from Trading Economics about average house prices. This is a 5-year chart. I also want to show you total housing inventory. This is a 1-year chart, and you'll notice that housing inventory is still much too weak. Here's a 5-year chart of total housing inventory. And then one more chart. This is construction spending. The more construction spending, the more houses get built and put into the inventory, thus lowering overall prices. But if you remember, it wasn't too long ago that lumber prices were incredibly high. It was a big problem. We're only looking at it from January 1st, when they were at $572 per board foot. But if you look at this chart of lumber prices, long-term chart, you'll see there and there, that's when there was a massive problem with the prices of lumber. When inflation was running out of control, and all of a sudden you're paying so much more for the lumber that it's actually affecting the number of houses you build, number of houses that get bought because the price is so much higher. There's a couple of times there recently when people were really feeling the effects, industries were really feeling the effects of really high lumber prices. And now inflation is starting to scale down. Except for grocery bills. People are going to buy their groceries, they're still paying more than they used to. They're feeling it still. And this is even after or during a time when Walmart and Target are lowering prices on thousands of items across the board. We're still not quite back to where we were, to a more comfortable level, where families aren't so strapped or taxed. This is from Trading Economics. Cheese prices. And I'm getting ahead of myself here a bit, but you'll see that they've gone up to $2.05 from $1.55 only 6 months ago. But I did want to talk about copper. It was at $3.84 January 1st, 2024. But here's a long-term 45-year chart from Macro Trends of copper prices. Plus, check out some of these headlines that I pulled up for you guys. This is from Bay Street Staff. Copper prices surge amid supply cuts and AI demand. A new supercycle begins. And this is from oilprice.com. U.S. automakers race to offset the rise in copper prices. And this is from carboncredits.com. Why copper prices are surging and what to expect. No matter how you look at it, copper prices are likely to rise in the next half of this year, especially when they start lowering interest rates or printing new money. For talking about in terms of the United States. But overall, as the global economy bottoms out and then starts building up again, there'll be more demands on copper. There's industries like artificial intelligence, electric vehicles that are demanding more copper to produce the products that they're going to produce. The lower inflation goes, the more likely the Federal Reserve will lower interest rates, which will spike things like stocks, precious metals. It'll hurt the US dollar. Oil and other commodities will climb much higher in price, including cheese and copper, and cotton and coffee, and pork bellies and soybeans. I still believe that we are going to have a recession, especially because we're just now entering the height of this default deluge I've been talking to you guys about for many years now. It's all starting to happen now. A lot of bankruptcies going on right now. Rising delinquencies, rising homelessness, rising layoffs, unemployment rate will climb. Along with all this awareness, especially among other countries worldwide that are watching it happen, they know that we're taking advantage of the US dollar just by printing more and more of it. It's all going to lead to a banking crisis, very likely in the next couple of years, and a dollar crisis eventually, when people say it's not logical that you can just make up a whole bunch of money and then buy a whole bunch of stuff and we give it to you. Meanwhile, you've got a lot of bankruptcies to come from a lot of these office buildings that are less than half rented out right now because everyone's working from home, or they've been replaced by artificial intelligence. Federal Reserve will drop rates, but they will do that too late. They'll do it when they have to because the economy itself is going the exact way that I expect it to go. Then, when it's already falling, they'll come along and go, we're going to save the day. They'll drop rates aggressively. They'll print another massive deluge of money, all of which deteriorates the value of each individual dollar. If you have $1 and there's only 100 of them, that's a valuable dollar. If you have $1 and there's 10 billion of them, that dollar's not worth as much because of the unbridled supply of them. The Federal Reserve will instruct the Department of the Treasury to produce a tremendous amount of money. In my script here, I wrote exorbitant. That's going to drive inflation. It'll spike stocks and real estate and cryptocurrencies and bread and cheese and bus passes. Everything will cost more because the value of the dollar is less. So January 1st, gold prices were $2,062. Then by June 18th, they were $2,338. A pretty strong rise while there's such a massive global demand for it. Plus a risk premium from all these wars breaking out. Silver prices likewise went from $23.79 to $29.46 and outperformed gold in that time. I told you that silver will always outperform gold on average over time as long as the gold to silver ratio is so out of whack. It's really high right now. It's at 78.92. That's historically very high. Historically, it should be closer to 40. But on January 1st, it's at 86.70. So over time, you saw that the gold to silver ratio normalized a little bit more. It'll keep outperforming. Silver will keep outperforming gold on average over time. Not every day, but every week, every month, because it will do that until the silver to gold ratio or the gold to silver ratio normalizes closer to 40. Oil was at $72.26 on January 1st of this year, and now, 6 months later, it's at $78.49. Yeah, a little bit higher, but absolutely not even close to where it should be based on all these massive macroeconomic events that are playing out right now. If you think that the Cuban Missile Crisis was a big deal, this is the situation we're in right now is so much more extreme and important and possibly devastating than that actually was. There's too many flashpoints and too many small groups of people who can affect things going on that are going to decide that they want things to get worse. You don't need an entire country to go, okay, we're going to go to war with this other country. You just need a small selection of people who have military capabilities to decide to do something. You're seeing this with the Houthi rebels. You're seeing this with incoming missiles from Syria into Israeli territory. There's zero chance, very low chance that Israel does not have to have some kind of military response to Hezbollah. And I'm not putting my own position on this at all. I'm just telling you guys it's almost certain to happen. And when it does, it's a massive, massive escalation in every aspect of everything. Oil prices should be over $100 already based on what is obviously going to be happening, in my opinion. Real estate went from $498,300, which is already out of affordability for anybody that's going to be buying a house, for most people. And now it's already gone up from then to $513,300. That's according to the St. Louis Fed. Lumber went from $572 per board foot on January 1st to $495 now. So that's an example of one of the things that is decreasing in price. There's a lot of them right now. But as I told you earlier, it's not the same with cheese, for example, $1.55 to $2.05. And copper rose from $3.84 to $4.50. And that was over a time when a lot of economies, Germany, China, were slowing down. It would have been even more extreme of a rise if these economies had been picking up speed at that time. But copper is just another commodity that, as I said, it's a great reflection of economic activity, but all commodities will increase in price in countermeasure to the direction of the US dollar. When the dollar goes higher, a lot of commodities get cheaper because the dollar is more valuable. When the dollar goes lower, you have to pay more dollars to buy the same amount of whatever asset, whatever commodity. But the real question is, where does all this go next? I called it for the Canadian real estate market, and that could have been called by an 8-year-old kid, because Canada's real estate market was the most heavily overvalued real estate market anywhere on the earth. And it wasn't too difficult to know that it was going to be coming down. But I also think that U.S. house prices are going to come down a lot. And they haven't yet. They keep climbing. And you can say it's about inventory, you can say it's about inflation. But when something gets so out of realistic reach, the people who are going to be buying the houses, when it's difficult for them to do that, there's eventually a breaking point. I don't think that any of these house prices will be anywhere close to where they are when and as we enter a lot of dark times ahead for the economy that I'm seeing coming. And yes, a lot of great things are happening for the economy. Things are being touted about, wow, low unemployment, etc. Yes, but overall, the entire economy is fueled by debt, growing debt. That's why we keep just taking on more and more debt and creating more and more money, but we're not actually creating the money as much as just saying that it exists. We're not creating it through productivity. If your neighbor is living off debt, driving a fancy car, he's broke. The interest rates will be lowered, especially in response to any kind of economic breakdown, and even more especially in an election year. The recession will get here, and when it does, unemployment will start climbing higher. Unemployment's always low until the recession shows up. Precious metals will continue to climb in reverse to whatever happens with the US dollar, which I'm expecting to come down pretty dramatically. It's held its strength up pretty well. A lot of worse currencies are keeping it lofted, but it's a bunch of currencies all comparing themselves to each other that are all fiat currencies. It's all just smoke and mirrors. Nobody's comparing it to gold. Gold is worth more than any other currency worldwide. Every single currency which exists, it takes more of that to buy gold. And gold, this whole time, thousands of years, has never changed price. Oil will continue to fade under the pressure of slowing economies worldwide, especially when the recession gets to America, but it will be prone to massive, sudden spikes, 5% higher, 10% higher, when one event happens. And then it'll start trickling down after that. It might spike again, trickle down. But overall, it's heading lower, as we'll also see for lumber and cheese and copper prices. They will all drift lower, but be mainly range bound. Nothing dramatic is going to happen with these. You are going to want to keep an eye on a lot of this stuff, especially the macroeconomic events that are happening right now. This is so huge. This is so huge, and nobody's paying attention to it, feels like. You can watch, you can search. If you look for it, you'll find it. Take a search for Hezbollah to see some of the things that are happening there right now. Hundreds of missiles being shot each way. This is before an actual official war breaks out. If you want to keep an eye on it, like I'm suggesting, definitely subscribe to these videos. I'll help keep an eye on it for you.
The Peter Leeds newsletter is one of the most popular financial publications of all time.